Hello everybody, welcome to the September 2020 monthly market report. This is for you if you're a real estate agent needing to inform a client or prospect on the current market, or perhaps you are a financial advisor needing to do the same, or perhaps you are that potential buyer or seller looking to make an informed decision. I'm Paulo Rodriguez. I've been a mortgage professional since 2005, and I'm excited to share data-driven information that will help you with whatever your real estate endeavors may be. In this report, we're going to talk about things going on in the economy and the recovery. We're going to talk about some things that are questions that people have, and we're also going to talk about some of the great things happening in the market, like affordability. So I look forward to spending the next few minutes with you. Now, if you remember the slide from last month, you'll recall that I described this as a leading indicator. This is traffic from across North America in terms of home showings, whether they be virtual or in person. And as we look from left to right, we see that we started out the year okay, then we dipped down during quarantine when people literally couldn't leave their homes. And this shows, just coming out of that, the seemingly insatiable demand for housing. This just illustrates the above average number of people that are raising their hands and saying, I need to buy a new home. The next set of data that I want to pull up here as we start to craft the story of how the market is performing right now is purchase applications. What you see here is week over week figures. In other words, how many applications were there this week as compared to last week? And if we read from left to right, we see that COVID hits at the beginning of March, and then we see the 4 consecutive weeks of red, and then a lot of green through mid-June from all of the pent-up demand due to quarantine. And now for the last 5 or 6 weeks, we've kind of leveled off towards stability, suggesting that the pent-up demand has been absorbed by the market. Now that we've taken a look at week over week purchase applications, let's take a look at what the year over year applications look like. Again, reading from left to right, we started out the month of March pretty strong, and then COVID hit, and then people came out of the woodwork wanting to buy a new home. And where do we stand right now? Well, we just discussed week over week in the previous slide and saw that this week's applications were roughly the same as last week's applications. But when we compare this week to the same week last year, which is what you see on the screen now, you can see that we are up by almost 30%, which is massive. Now let's do the same exercise again, but for pending sales this time. We'll take a look at week over week data and then year over year. So we'll start with week over week. And again, if we start from left, we can see in March, we were moving along pretty well, dipped down during quarantine. And then during the summer, you can see the pent-up demand being absorbed by the market and drastically reducing available inventory. And then for the last 5 or 6 weeks, we've leveled out. But just like with purchase applications, pending sales tell the same tale when looking at year over year data. If we look at this bar graph, you can see that we are holding steady in the mid-teens when comparing the current weeks to the same corresponding weeks in 2019. So in other words, 2020 continues to prove to be a much stronger year for real estate demand than 2019. Now I want to circle back and talk for a minute again about home showings, because this statistic here is absolutely mind-blowing. We've seen a lot of positive growth since quarantine on home showings. We started out the year very well, but we've seen that continue either virtually or in person. And this bar graph shows home buyer traffic jumped again in July, recording a 60.7% national year-over-year increase. Here on the screen, you can see it broken down into territories, but on a national basis, let me reiterate, we are up 60.7% year over year in nationwide showing activity according to the data from Showing Time. So needless to say, there's a lot of demand right now, and what's driving that demand is what we spoke about last month involving the changes in people's needs in a home, such as moving away from high density areas, being able to work from home, being able to homeschool children, having a backyard, etc. Now, of course, all of this wonderful demand is creating a challenge across the country, which is inventory. And according to Danielle Hale of Realtor.com, most recent year-over-year total inventory was down 38%, and buyers continue to be motivated by low mortgage rates and the strong desire for certainty of ownership in an uncertain world. And they're very quickly putting offers on homes that come up for sale, driving the overall number of homes for sale lower and lower. So we know we've got a lot of demand. We know we are limited in the number of homes for sale. And if you are a prospective seller of your home and this doesn't convince you that now is a good time to sell, then I don't know what will. My clients and realtors need your inventory, so please give me a call. Now I want to give you a look at what experts are forecasting for pricing going forward in the next 12 months. And you can see the overwhelming majority, 8 of the 9 surveyed here, are calling for positive price appreciation. Some are projecting for this current year, some for the next 12 months, but regardless, most of them are calling for 3 to 4% in price appreciation. Again, this is governed and dictated by the lack of supply and the overwhelming demand. Now, I want to jump to the slide for a moment because I think it's really interesting and it underscores that nobody could have foretold what the effects of COVID would be on the demand for real estate. These are three major players and their predictions for home prices at the onset of the pandemic as compared to today. Fannie Mae went from saying we're going to see appreciation of about 0.4% to 4.4%. Zillow completely flipped on from depreciation to appreciation, and CoreLogic, we spoke about this last month, also had a very large correction. It'll be interesting to see what corrections are made as we progress from here. So all good news relative to the health of the housing market, where we stand with prices and appreciation going forward, and all of that being fueled by people saying we need a home. There are different reasons that we need a new home, that is, and we're more motivated today to go out and buy one than we were previously. Throw low mortgage interest rates on top of all of that, and you've got a very hot real estate market. Now, there are some questions in the market that I think we need to take a look at. One is that of forbearance, which for the last 3 weeks has started to level off, and it would be preferable to see that number continue to drop. I've talked a lot about forbearance in the past, and it's something that I have been watching, but I must admit, I don't have all the answers right now, so all we can do is continue to watch it. The burning question that I personally have is, what is the effect of the Payment Protection Plan, or the PPP loan, and are we seeing forbearance numbers leveling off instead of dropping because small business owners are running out of PPP funds? The future question is, what's going to happen with those homes and those people that are coming out of forbearance? That's the big question right now. Bankrate's senior mortgage reporter had this to say: the COVID-19 pandemic will lead to a rise in mortgage defaults and foreclosures, but as the housing market muscles through this economic downturn, it looks as if the foreclosures will form a trickle rather than a flood. We've talked about the significant amount of equity that people have in their homes currently, and this provides them with options. And I have to agree that foreclosures will happen, but it will be nothing like 2008. One of the primary reasons being the amount of equity that people have in their homes today. If you take a look at this graph depicting the percentage of distressed property sales, you can clearly see that we are currently in a historic low. Why? Because there is a moratorium on starting foreclosure proceedings. They literally cannot start, and as people extend their forbearance, that gets pushed out further into the future. As people come out of forbearance, no doubt there will be some foreclosures, but I have to agree that it will be very much a trickle and not a flood. So the big story right now, I think what we need to be talking about is affordability. And this is a quote from a Black Knight study published by Mortgage News Daily, and it says, those shopping for a home can afford 10% more than they could have 1 year ago while keeping their monthly payment unchanged. This translates to the nearly $32,000 more in buying power. And for most parts of the country, that is a lot. And that is what we need to be discussing with prospective buyers. If we look at the Housing Affordability Index from the National Association of Realtors, we can see just how affordable housing is today. The higher the index, the more affordable housing is. So if you look at today's numbers, you can see that homes are nearly as affordable as they were when distressed sales dominated the marketplace in the years following the financial meltdown of 2008. And of course, that was a time when there was an overabundance of inventory and not a shortage like there is today. So very, very good news relative to affordability, relative to people being able to go out there and afford more of a home that will fit their needs. The challenge, like we said, is being able to find a home. So as we start to look at 2021, we need sellers to list their homes for sale. We need to bring more inventory back to the market. That is the need right now. And here are a couple of interesting quotes from the chief economist at the National Association of Realtors. And he's forecasting existing home sales to ramp up to an annualized run rate of 5.8 million in the second half of 2020. And that expected rebound would bring the full year level of existing home sales to 5.4 million, which is a 1.1% gain compared to 2019. Who would have thought we'd be sitting here in September saying we have a chance to beat last year in the total number of existing homes sold despite COVID? Looking at what we've been through, we know that economically things are improving. The September unemployment report came out at 8.4%, and while I'm not suggesting that's a good number, it is considerably lower than what it was. The economy is doing better relative to unemployment and consumers being able to spend again. And we're seeing the real estate market responding very, very well coming out of the health crisis. The second quote is one that is exciting to me, as he goes on to say, home sales will ramp up again next year, increasing between 8 and 12% as we go into 2021. So a lot of good things happening out there. The market's settling out above where it was last year. Questions about forbearance we're going to stay on top of, but the story really is affordability and growth going into the fourth quarter and into 2021. So that's a wrap for the September monthly market report. I appreciate you listening in. We will be back next month, but before you go, if you're looking to purchase or refinance, or you know someone that is, and would like a no-cost consultation with me personally, feel free to reach out and I'll be happy to analyze if your debt is structured in the most optimal way or if there is room for improvement. Thanks again for tuning in. Bye for now.